Hello everyone, I hope you are doing good wherever you are. Welcome back to our channel, and today I'm going to be sharing with you about enterprise growth and size. Just to do a recap a bit, in my previous video I've shared with you about the approach to the paper 1 questions, the approach to the paper 2 questions, the business activity topic, as well as the business classification. So let us see what this topic has for us. So on this topic, you need to understand the following. First one, you need to explain the meaning and characteristics of an entrepreneur. Explain the meaning and the contents of a business plan and show how the business plans assist entrepreneurs. You need to analyze why and how governments support business startups. You need to explain the methods and problems of measuring business size. You need to analyze why some businesses grow and others remain small. And also you need to analyze why some businesses fail, either new or already established businesses. So let us look at the first assessment objective. Let's talk about entrepreneurship. For entrepreneurship to be there is supposed to be a person called an entrepreneur. So who is an entrepreneur? It's a person who organizes, operates, and takes risks for a new business venture. So this person has the ability to combine or bring together land, labor, and capital in order to start a business that will help generate or produce a good or a service, which they sell to the market and generate some revenue and profit afterwards. So the reward of being an entrepreneur, it is the profit. That's their main objective, to generate a profit. So for you to become a successful entrepreneur, what are the characteristics that one is supposed to have? First one is hardworking. You need to be able to work for longer hours in order for you to meet all your objectives that you have set. And also nowadays, people are being, or entrepreneurs are being encouraged to work smart, not only to work hard, but be smart. Secondly, risk taker. In order for you to become successful, you need to be able to try a number of business ideas until you become successful. Not only will you utilize one idea and become a success, sometimes you try 2, 3, 4 ideas and they fail until you reach to the 6th one, which may bring out some profits for your business. So try again until you make it. Thirdly, creative. You should be able to bring about new business ideas which are unique, which are different from your competitors, and that will enable you to outcompete them and attract a greater market share, meaning to say more revenue on your side. And also, next one, you need to be self-confident. You must have that high level of confidence which will allow you to convince banks to even give you a huge amount of loans, or investors to come and buy shares in your company. So you have the confidence in you, in whatever activity that you do. And also be an effective communicator. The way you explain and analyze concepts should be clear, not vague. To who? To all your stakeholders. It can be banks, they're the ones who are going to give you loans. It can be the customers, they're the ones who are going to buy your products. It can be your employees, they're the ones who are going to help you produce and sell the product. So all the stakeholders are supposed to get clear information from you as the entrepreneur. Next one, optimistic. You need to have a positive mind. Always hope for the best, regardless of the number of failures that you experience. Always say to yourself, one day I'll make it. So that drive within you will see things through. We hope you see something great at the end. There is always light at the end of the tunnel. And next one, innovative. The moment you bring about new ideas, be able to put them into practice, to bring about some changes. It can be to modify your products or to improve the skills of your employees or to buy some new machines to be used to produce new products in your business. That's what innovators are. They put those new ideas into practice. And next one, be independent. Try by all means to work on your own before you employ others. Self-motivate yourself. Self-motivation is the way to go before you try to motivate others around you. So try to be independent, and everyone actually will join you to support your vision. All right, let's go to the next area, business planning. So all businesses are supposed to plan. Why? Because failure to plan is planning to fail. So businesses, for them to succeed, they need to have a guide, which is known as a business planning. So what is a business plan? It's simply a document that contains the business objectives and the important details about the operations, the finance, as well as the owners of the new business. So plans are very much important for a business. For what purposes? The first one here is the plans are used when you're applying for bank loans. Banks, they need to see what your business is all about. So you need to present the plan when you apply for a loan. Secondly, plans, they help the business reduce the risk of failure. The moment you now understand the product you are going to produce, the costs you are likely to incur, and your firm location, as well as the machinery that you're going to use, and also the qualities of employees that you require. The moment you understand all that, you are able to bring about the best, and your risk of failure is likely to be minimal. So prepare a plan before you start your business operations. The plan also helps you direct your efforts. So it gives you a sense of direction. All right, let's go to the next part. So plan. People produce plans in a variety of ways, but here are some of the contents that you may include in your business plan. First thing is to write about the details of the owner or the owners, depends on the business setup that you have. So this outlines the background of education of the owners and also their previous experience that they have, if they have worked in some organizations before, or if they have other businesses before the one that they have now. The next thing is about the business idea. What exactly do you seek to provide the market with? So which good or a service are you going to produce and sell to the customers? That's your business idea. And also, a plan should also explain the aims and the objectives. So the targets, the aims, what you seek to achieve is supposed to be included in your plan. And your objectives should be SMART. And by SMART, we mean what exactly? SMART is an acronym that stands for S, specific, M, measurable, A, attainable, R, realistic, and T, timeframe or timeliness. So your objectives, for them to be effective, they need to comply with these principles. And next thing is about target market. So a market is about the customers that you seek to sell your products to. So for you to be able to determine the target market, you need to conduct a market research, collect data, either through desk or through field research, understand your market, their levels of income, or anything that relates to your market, which may affect your business. Understand that. And also, next thing is about the revenue. Revenue is simply the amount that you generate from goods sold or the services rendered. So by this, you need to understand the quantities you are likely to sell and the prices to be charged for the products in order for you to have the amount known as a revenue. And next thing is about the projected costs. So every business, for it to operate, it incurs costs. And the costs can be costs linked to the sales or the services being rendered, or costs linked to the operations of the business overall. So you need to sum up all those costs, right, that you're likely to incur in future. And when you say a revenue minus total costs, the result becomes your profit. And the profits are used to reinvest in the business. So you need to have such details on your plan. And next one is the cash flow forecast. Cash flow forecast is all about the forecasted cash inflows and cash outflows. So all those activities that are likely to generate income for the business are supposed to be outlined. And also all those activities that are likely to have a cash outflow, all right, are supposed to be included in your cash flow forecast. And this helps the business to assess their level of liquidity. And next thing is about sources of finance. Finance is like blood in the human system. Businesses require finance for them to operate effectively. So if they do not have sufficient finance as a business, they can go on to source it from other areas, which includes the long-term and the short-term finance. Some are internal sources, some are external sources of finance. So we'll talk about this in depth in the topics to come. And also talk about location. Where is the business located? It's a point that matters the most. It determines the proximity of your business to their customers. Like how convenient is it for them to come through and buy your products? So if you are far away from your target market, that means you may go on to sell less, or you may go on to render fewer services than if your business is closer to your market. So some of the points we have talked about up there can be summarized in what we call marketing mix. It's a topic as well to be talked about later on. So marketing mix, it talks about the 4 P's of marketing. The 4 P's include product, price, place, and promotion. So since we talked about product up there, prices, the price you charge are supposed to be reasonable and affordable to that target market. Some of your customers are low-income earners, some are medium-income earners, and some are high-income earners. So your price is supposed to be in line with your target market. And also place, that's location. Then we have what we call promotion. Which advertising methods are you going to use to create awareness of your product? And which sales promotions are you going to utilize to attract customers to your business? So all those areas may also be included in your business plan. And lastly, other resources that you may require to operate the business, for example, the machines and the employees. By this, we refer to the types or the qualities that you expect to have in your organization. What level of skills, number of years experience that you require from the employees you are going to have in your organization. All these areas may be included in your business plan. All right, let's go to the next part, which is government support. Governments, they support a number of businesses in a country, and there are many ways that they do that. So let us begin first by talking about the reasons why the governments support the new businesses. There are many reasons for doing that, just to name a few here. The first one, the new businesses, they create jobs. If there are many businesses around, that means they're going to employ more people. And that reduces one of the governments or the economists' macroeconomic objective. They reduce unemployment. And those employees who now earn an income that will allow them to improve their welfare and living standards will improve overall in that particular country. And the next thing is about increased competition. If the government go on to remove some regulations that limit entrepreneurs or businesses to open, then we are going to have increased competition. And when there is increased competition, these businesses are going to be forced to reduce their prices in order to attract customers. And also they're going to improve the quality of the products they are going to produce. Why? Because customers, what they call for the most are lower prices and improved quality products. So all these are a result of increased competition. And the next reason is the moment those businesses grow larger, they will contribute towards the country's economic growth. And what is economic growth? It's simply an increase in the gross domestic product. And what is gross domestic product? It is the total market value of goods and services produced within a country over a year. So all this is a result of us having many businesses operating in a country. Hence, the output will also increase. And next reason, the moment these businesses grow to be successful, they are likely to export more goods out of the country. All right, so the moment they increase the exports, that means more foreign currency is going to be generated by this particular country, and also more jobs are going to be created for those people who will be facilitating the exportation of the goods. And next section here, it's about the ways in which the government may support the new businesses. The first one is about loans at lower interest rates. So governments may issue out loans to the businesses, but with their rates below the banks. So why do they do this? First, let's understand the meaning of interest rates. Interest rates in this context is a cost of borrowing. So if the cost of borrowing is now lower, that means more businesses are encouraged to borrow more loans and to use the funds to invest in their operations. So lower interest rates are an incentive to borrow loans or simply huge loans from the banks. That means an increase in investment on the part of the businesses. Next one, lend to set up businesses at low cost. So government may allocate some areas in which businesses may set or may construct their premises. The areas actually may have lower cost, like the prices can be lower and the cost of maintaining that particular area can also be lower. So all this is very much attractive to the businesses. And in some cases, the government may provide already built facilities for those businesses which may want to operate and contribute towards the economic growth. Next thing is about subsidies and grants. Subsidies and grants. It's simply the financial aid from the government. Subsidies are meant to boost or to improve the performance of the business in a way that will lead to a reduction in their cost of production. So they can be used to hire new employees, train employees, construct buildings, purchasing, or simply the asset acquisition. So that's what the businesses use the subsidies and grants for. That financial aid, it covers a lot of cost for the businesses. And hence, they will have more funds available to invest and to improve the business performance. And next point there is about give tax breaks. Tax breaks and or holidays, they are very much important. It's all about the withdrawal of taxes, or simply the government may decide that a business should not pay tax for the next 6 years or maybe 10 years until their activities are performing well. Then they may start paying taxes thereafter. So all this is done to encourage businesses to have more funds available in their pockets, the one that we call disposable income. So their income minus the tax, the result or the answer there is known as disposable income. So that income will be higher since there is no or there's less tax being charged, and hence more funds are available for them to invest in their business. And next point there is the use, right? The governments may allow the businesses to use their research facilities at public universities. So all this actually, it allows the business to even go on and perform some experiments of their pilots or their products. They can go on together and research more information for free. And also the government may provide some business advice from their own experts, or they may invite experts from outside the country to provide the business advice to the new businesses on how best to operate and become profitable. So these are some of the ways that the government may support new business or new businesses with. Let us go on to the next section. So the moment those businesses are now operating well, they will think about increasing their size. They will think about growing, employing more people, producing more output, selling more goods to the markets, locally and also internationally. So which methods and what problems are we likely to face as we measure the business size? The first one, we can use the number of employees as a method. So the more employees that you have, that may mean the bigger the business size. This is also very much easy to use, easy to calculate and compare with your competitors. If they have fewer employees, that may also mean they are a smaller business than yours. But however, some businesses, they produce more output with those fewer employees. Why? Because they have more machines being used. So this means some businesses may be capital intensive. They use more machines than employees. So this may affect this method when it comes to its relevance in the calculation or measuring of the business size. Secondly, we talk about the value of output. Output is simply the goods or goods produced or the number of customers you have served. Right, so this is very much easy to calculate and to compare with your competitors as well. So if you produce 20 units and the business produces 10 units, that simply, or that may mean your business is bigger than business B. But however, some businesses may be very small, but they may produce very expensive products, such as brand name clothing, while a very large factory may be producing cheaper clothing. So, in as much as we consider the number of units produced, we also tend to consider the value of the output. It also matters most. All right. So next point here is about value of sales. So this may actually mean the sales revenue, the amount of revenue that you receive from the goods you have sold or the services you have rendered. So this is very much easy to calculate and compare with other businesses. If your business is generating 20 million out of its sales and business B is generating 5 million from its sales, then yours may be defined as a bigger business than business B. So it's very much easy to use. But however, the value may be different for businesses. For example, a sports car dealer may sell 2 cars, while a normal car dealer, for example, Toyota, may sell 20 cars a day. So this may mean actually you may not be in a position to compare these two businesses well, regardless of them all selling cars, but the type of cars they are selling, they are different. So this may not work well when measuring the business size. And lastly, we can use also the value of capital employed. So capital employed is all about the capital or the shareholders' funds, all the resources that we have invested in the business, plus all the amounts you have acquired from other sources, but only the long-term sources of finances. So non-current liabilities plus the owner's capital. Combined, we have what we call the capital employed. So if you have a higher amount as company A and company B is a lower amount, that can also be used as a way to measure. So it's a simple method which can be used to compare businesses. But however, this method is inaccurate. Why? Because different factories will use different types of capital. Remember, just like the first point there, some factories or some businesses, they tend to be capital intensive. They may use more of machines than employees. And some may use more employees than machines, meaning to say they are labor intensive. So such differences may make it to become difficult to compare or measure the business sizes. So what are we saying about all this? There is no perfect way to compare businesses. since every business is different in its own capacity. All right, let's go to the next part. So many businesses, they have the desire to grow. So why do they want to grow? In order for them to increase the chances of higher profit. The moment they grow, they can sell their goods to a lot of customers around, either locally or internationally, and hence more profits will be generated. By growing as well, they may gain a better status and prestige, both for its owners and also the employees. By you working in a popular organization, it gives you that prestige, that status in the society. And also, it may also result in what you call economies of scale. This is going to be a topic to be covered in depth later on, but it's all about all the factors that may lead to a lower average cost or simply a lower unit cost. And by having that, you can have more negotiating power that may lead the business to increase its profits. And lastly, we can talk about increased control of the market. The moment you grow as a business, it means you are now serving more customers in the market. You now occupy a greater percentage of the market share, and hence you tend to have more control of it. So what do you control? The prices, that's number one. And secondly, the quality of the products. You have the power to control them all since you are serving a greater percentage of the market. So a business may grow through using a number of ways or two major ways. All right, the ways can either be internal, through internal growth, or external growth. Can also be defined as integration. Internal growth and external growth can also be known as integration. So internal growth is all about the business growing by itself, or it's now expanding its operations. It's now opening new branches all over. It's now building more structures around. So all that is possible when you are generating more profits to finance or invest such activities. So profits are going to increase when you attract more customers. The more customers you attract when your costs are lower, that means more profits are going to be generated. So that's the first way businesses grow, internal growth. Secondly, external growth. This one happens through or when a takeover or a merger happens with another businesses. So what is a takeover? What is a merger? A merger, that's when two or when the owners of two businesses agree to join their firms together to make one business. So the owner of business A, the owner of business B, they come together and say, let us combine our businesses and work as one. That is defined as a merger. It's a voluntary integration. Then we have what we call takeover. Takeover, it occurs when one business or an individual buys out the owners of another business, which then becomes a part of the predator business. So this happens through the share acquisition normally. So when an individual or a business go on to buy more shares or simply majority shares in a particular company, legally they become the shareholder or the owner of that particular company or business. So external growth, it happens through two major ways. Let's talk about them. First one is the Horizontal integration. So horizontal integration is very simple. That's when firms or businesses which are in the same industry and at the same stage of production, they merge or they combine their businesses. For example, two bakeries, they may merge to form a larger business. Two high schools may also merge to become one larger school. Two transport businesses may also merge to become one larger business. Secondly, we have what you call vertical integration. Vertical, it happens when another business merges with another business which is in another stage of production. So when two businesses which are in different stages of production merge or they combine the activities to become one, that is known as vertical integration. But it happens through two ways. It can either be backwards vertical integration or forwards vertical integration. Backward vertical integration is when a business merges with another business in a different or in the previous stage of production. For example, we can talk about a bakery may go on to merge or to integrate with another business in the wheat farm, or simply with the wheat farm, a bakery and the wheat farm. Remember, a wheat farm, it supplies the bakery with wheat, which they grind and use to bake their different goods. So if you're going backwards, it means you're going to the supplier of your products or the raw materials that you use. It's called backward vertical integration. Then we have what you call forward vertical integration, when a business merges with a business or another business in the next stage of production. For example, a sugar farm merges with a candy factory. So the candy factory, they buy sugar from the sugar farm and they produce various candies. So if that farm goes forward to merge with that particular business, is called a merger. Or it can be a wholesaler which goes forward to merge with the retailer of its products. Or it can be any producer going to the wholesaler or going to the retail of their products. That is called forward vertical integration. So integration, either backwards or forward vertical integration, is very much beneficial because one will have more power to control the other. For example, if you are, in this case here, if a bakery merges with a wheat farm, it means the bakery has more power to control the supply of the wheat. They'll provide them with more wheat and supply others with less. And if a sugar farm merges with a candy factory, that means they will now have power to control the prices being charged to the various customers in the retail outlets as well. All right, so there are some of the benefits of vertical integration. And also, we have two other ways businesses may use to grow. Here we have the conglomerate merger. Conglomerate merger, that's when two businesses in a completely different industry or industries combine to form a new business. For example, an insurance company buys an advertising agency. A school merges with a transport business. A grocery store merges with a clothing store. These two businesses are in different industries, but they come together, combining their activities to become one. It's called a conglomerate merger. And lastly, we can also talk about the joint venture. This is when two already established businesses agree to start a new project together. It's a way as well of growing, but these are two already existing businesses coming together. All right, so, and they're also starting something different, something new together. So it's a way as well of growing somehow. So here are some of the ways a business can grow. Let us talk about the next area. So the moment you grow, just like us humans, we all want to grow. When you are still young, you're saying to yourself, I want to grow old and do A, B, C, D. Same as the business, they want to grow. But the moment you grow, there are challenges which comes with growth. So for a business, the moment they grow, it becomes difficult for them to control their activities. So that's a challenge they face. And the best way to deal with that is for them to keep on operating their business in small parts. Power should be decentralized. Don't withhold all the power as the owner of the business, as that will give you more stress, but rather decentralize, appoint some head of departments, supervisors, and they can perform their duties on your behalf in their respective areas. Secondly, costs of expansion are high. So if you are maybe still a new business, it can be difficult for you to finance all the activities happening around the business or all the investments to be done. So the costs may be higher, that your profits will be washed away. And if there are losses being experienced, that means the business may fail. And also poor communication. Since you are now a bigger business with more branches, or maybe you're operating in many continents, for you to communicate with each and every employee or manager in those respective branches, it will become difficult. And you won't be able now to understand the needs of each and every employee in your organization. So what can you do to improve or to deal with this problem? You can utilize emails to communicate. Nowadays, businesses, they use even Zoom to communicate with their employees in various areas of the world. Or you may decide to operate the business in small parts as well. And next one here is lack of expertise. The moment you grow bigger as a business, you need to attract competent people, meaning to say what? Those employees who have the rightful skills, knowledge, as well as experience on how to perform the activities. Those employees who can manage and coordinate the activities, even in your absence, they're the ones you need to attract. So it might be difficult for you to do that as well if you lack the finance. And lastly, the moment you grow beyond a particular point or certain point, your business may end up experiencing higher average costs, or simply unit costs tend to be higher after a certain period of time. And if your costs are now higher, that means your profits are going to be affected. They're going to be reduced. And if their profits keeps on being reduced, you may fail to operate the business in the long run. All right, and next part here, let's talk about the reasons for business failure. So businesses, they do fail. It's common. And some, they thrive forever. So what are some of the reasons why businesses fail? First one here is poor management. Managers should be in a position to perform all the management functions, such as planning, organizing, coordinating, controlling, And also communication should be effective in the organization. So if the management don't have the capacity to make good decisions for the business, the result is failure. Secondly, failure to plan. Planning is very important. Just like you making a business plan, you need to plan as well continuously for the business. Why? Because the business environment is dynamic. It is constantly changing. So if you fail to stay abreast with the changes happening in the environment, you lose your market share, you lose your profits. And next thing, your business will fail and shut down its operations. So keep on planning and plan effectively. Next is the poor financial management. Some employees, they are related to the employer and they do some embezzling of finances. And some, they don't know how to utilize the funds well. And some don't have the skills on how to budget as well as to do the variance analysis. So the result in such a case will be misuse of cash. So as a business, you need finance, just like the humans, we need finance, we need blood in our bodies. So if you don't have finance as a business to operate or to pay your employees, the result will also be failure. And over expansion. Some businesses, they may go on to get some huge loans from the banks, or they may have some profits which are supernormal only for a particular period. And they may decide to open more branches around, but they may fail to operate them in future if they do not constantly generate enough profits to maintain those activities. So don't simply expand, but plan effectively for it. And also startup risk. Starting up a new business is always risky. Just like everything we do in life is risky. Driving a car is risky. Opening a business is risky. Building a house is risky. Many activities are risky. But as an entrepreneur, if you lack the experience and you don't have the ability to compete with larger business, the result is failure. So gain some experience first before you decide to open and run your own business. Right? And next point there, next area to talk about is why new businesses are at a greater risk of failure. First one here is lack of experience. Remember, they are still new. They lack exposure of what's happening in the market. And many firms, they tend to be pushed out of the market if they fail to strive in that market. So try by all means to understand the market first before you venture into it. So if you are also new to the market, you also have a greater risk of failure. Why? Because you don't understand more about the market nuances and also the trends in the market. You don't know how the competitors are operating well. So try to conduct a market research before you decide to start any business. Know your competitors, know their marketing strategies, know their prices they're charging, quality of their products, their sources of raw materials, etc. Anything that you think will affect your business, understand that first before you decide to open your own business. And also, remember, this is a new business. They are yet to make a lot of sales. So if there are less sales being made, that means less profits are available, all right, in this business. And if there is less amount of revenue, that means for you now to keep on operating at a loss, if there are higher costs here available, it might be a challenge for your business, as you may fail to even produce more goods. So failure will be the result. And also, this is a new business. They may fail to generate or to acquire huge loans from the banks, or even to invest their own funds to maintain their business operations. It can be a challenge. Or even to source funds from the family and friends may also be a challenge. So every business needs finance to operate effectively. So if you experience such financial issues or problems, you may see yourself actually failing to pay even your own employees, paying your suppliers, and the result will be failure. You may see your business shutting down its operations, you lose your market share, you lose your profits, and you may even also lose the properties, as they can be confiscated and used to pay back the amounts you have borrowed from the banks. So new businesses, before they start to operate, they need to conduct a market research and understand how the market is operating. And thank you very much for listening. I hope you're going to learn more in my next videos. And don't remember to subscribe and share the link as well with your family and friends. And I hope you're going to learn more, and share with me as well your views through my email. My email address is right here below. Just send me an email there, and I'll be there. I'll be here to hear your viewpoint. So next point here is about value of sales. So this may actually mean the sales revenue, the amount of revenue that you receive from the goods you have sold or the services you have rendered. So this is very much easy to calculate.